Welcome back in. Well, as you transition into retirement, if you're at that point, there are uncertainties that come with it, like are my investments in the right place so that I can actually pay my bills? Stewart Welch from the Welch Group is here to talk about the 3 common mistakes people make with their retirement. Good to see you, Stewart.
Good morning, Mike.
Yeah, I guess there's a lot of things we can really mess up, but these are some of the common ones that you see, right?
Well, I think if you're a pre-retiree, I mean, if you're earning a paycheck, you don't worry so much about the stock market. All of a sudden you retire, you're not getting a paycheck. Now you worry like crazy about the stock market.
Yeah.
You worry something like 2008 might happen where the stock market dropped 50%, and it will cause people to change the way they invest, and they'll make these mistakes.
Let's talk about the mistakes then and what people need to do to protect themselves.
All right, the first one is locking in a lifetime low income. And so what really comes to mind with me is an annuity. So we have annuity salesmen out there pushing annuities. I heard one recently where they were guaranteeing a 10% return. Let me tell
What?
you, yeah, let me tell you something. The 30-year Treasury, the 10-year Treasury are both under 3%. There is not 10% out there. So if you're hearing 10%, do not believe that. There's a catch somewhere. It might be 10% short term to get you in, but it is not a 10% long term. It's just not there.
And also, if they're getting commissions, if there's fees with that, you're losing really what you're gaining too, right?
You're absolutely right. You'll get in it, they'll sell you, you'll get in it, you'll realize you made a mistake, you can't get out. It's really lots and lots of penalties.
All right.
The next one is also, it's kind of like the first one, except it's owning too many bonds, too many CDs, too much money in money market. And again, it comes out of fear of the stock market.
Sure.
So they go in and they say, I'm not going to invest in stocks and lose a bunch of money. I'm just going to do it on the bond side. Well, let me tell you, the answer to this is during retirement, you're going to need at least 40% allocation to stocks, 40 to 60% allocation to stocks. And what I would suggest people do is take a look at dividend-paying stocks. So if you want to be more conservative, those big blue chip dividend-paying stocks are going to be more conservative.
Yeah, because that'll put money back in your account. The CDs, as you mentioned, even though your money's safe, you're not getting much in return to help you to pay your bills. So some things you should do, though, to really get yourself lined up.
Well, I think the last one is chasing yield. So
Okay.
they'll also say, gosh, I don't want to be in the stock market. I'm looking at bonds. Bonds aren't paying very much. CDs aren't paying very much. What is paying something? They'll go to maybe junk bonds or either lower quality bonds, or either they'll go longer term to get a higher yield. I think that's also a mistake. So I think you want to stay with high quality. You want to stay relatively short term, and you're going to have to get your growth out of those stocks. So that's why you've got to have that 40 to 60% allocation.
All right, so avoid those mistakes, everybody, and you'll be living a long life.
Yep.
All right, thanks so much, Stuart. Appreciate it.
Thank you, Mike.